Hello, everyone, and welcome to a new weekly market report, new weekly market review. Just to share with you my vision on the global markets, we're going to take a look on equity, we're going to take a look on fixed income, we're going to take a look on commodity, particularly on oil and on gold, and we're going to also end checking cryptos, Bitcoin against the dollar and the last movements of Bitcoin in relation with the dollar and with the global economy. First things to mention, we have to mention the end of the week. It was just the comments done by on Thursday evening by the president of Central Bank of Europe, Christine Lagarde, who raised the interest rates 25 basis points. She was also mentioned that she was suggesting, right, that probably is the last increase on the interest rate, but all other members from the Central Bank of Europe had been talking about the topic in the recent hours on Friday, saying that eventually, if the numbers are not good enough, they could still keep rising the interest rate. My vision on this is they must to keep rising interest rates for a very single factor. I have explaining to you, if you follow the previous reports, you will know this already. I have explaining to you that actually it's very simple. The main rule that they should apply, follow the books of economy, is if your interest rate, in this case Europe, is 4.5% and your inflation rate is 5.3%, if I take the reference has an interest rate has a reference is 4.5% and I take out the inflation, we got a negative interest rate because inflation is above the interest rates in Europe. In that case, the book is simple. The book is telling to you you cannot allow the interest rates get negative because that means that the capital assets are losing value every single day. And therefore, they need to follow the instructions, follow the book, and increase interest rates until the inflation is getting back to normal levels. Normal levels for them, remember, the target levels is 2% of inflation rate target. Initially, on the 90s, that was a top, a ceiling they could not break out. This was a kind of maximum levels tolerated in the European Union was 2% on inflation rate in a healthy economy. Today, it's a target to reach like 2%. So the goal is pull the inflation back to 2%, and the only measure, the only tool they got it to control this is mainly the interest rates. That's why I believe they're going to keep rising interest rates. What was the reaction of euro dollar based on this last news? Let me check. You will see that is actually dropping, keep dropping. I shared with you this chart a week ago, and apparently the price is going according with the plan. It was losing this channel, and I told you probably the next target was complete the range of the channel. If you take a look on the movement, it's exactly more or less the range of the channel projected to lower targets. And the level, I believe the level that we're probably going to face on euro dollar is going to be 1.05. 1.05 because it's a kind of reference that we have seen. That considering that the dollar is acting normal. If the dollar is actually doing what it did the last year in 2022, which was a massive rally, massive bullish rally, this also could include like the loss of the parity and go back again to the lowest levels, even lower than the previous year. And if you take a look on the moving average, we got the 200 moving average and the 50 days or periods moving average above the price right now, which means like if the price is keeping in below these levels for a while enough, you will see that actually both moving average is going to cross, making a bearish cross signal on the moving average, and then therefore obviously we're going to get more closer to those various targets in 105, even 1 or below parity. Okay. If we take a look, following this case, we take a look on dollar index, we will see that it's incredible. It's still pushing up. Now it's on 105 points, 24.6. So it's almost 105 points and a half. And it looks like it's keeping pushing further. And I believe that probably the target is touch the 106 points on the dollar index. And even if that prices, that levels are touched, yes, we're probably gonna face a pullback. We're gonna probably face a drop or a correction when those levels are being touched. But still, regardless this movement, what we can see is that a strong dollar, it's something that apparently it's happening because of a very simple explanation, which is the yield from US bonds. We got the yield from US bonds here. 2 years bond is giving to you 5.043% on returns. So it's a very attractive yield, especially if you compare that yield with the yield that German bond, 2 years German bond is giving to you is 3.2%. So obviously the money gonna move from German euro deposits to US deposits, and therefore the supply of the demand of the dollar gonna run out, and the price gonna be pushing up, which is, in my opinion, what is going on right now. If we take a look to the equity, we will see that actually here is the spot on Standard & Poor's. Let me see if we can also update. Here we go. And that's the movement I was sharing with you on previous reports that shoulder head shoulder figure or pattern, and I believe it still is active. We just need to follow closely the price, because naturally I think the price should drop to the area of 4,450, 4,400. Even the goal will be see these charts, this movement, this price is moving to the area of 4,400 points, and therefore in that area, if the prices are moving further, and if the neckline is getting broken, then obviously the projection of the price is going to take us lower and lower, which could be like $4,150, $4,120. And it's very risky to say this, because most of the analysts are considering now that this market is a bullish market. I'm just telling you, just watch out, be careful, because obviously we don't know what could be the response of the market after all of these numbers. In my eyes, it's a very simple situation. We can synthesize the situation, summarize everything in basically one scenario. The US numbers are going well. If the US numbers are going well, the Federal Reserve still can keep a strong position on interest rates. And if the Federal Reserve is keeping a strong position on interest rate, means like Wall Street won't get access to a cheap price, cheap money. High interest rate gonna drive the liquidity, because obviously if you got high interest rate, you're gonna get more incentive to hold your money in a fixed income or in deposits instead of investing your money in assets. Therefore, Wall Street want low interest rates. Wall Street want actually a Federal Reserve go into a soft posture and start to reduce the interest rate or even consider more flexibility. The problem is labor market in US is still, the employment rate in US is still below 4%. That is, they know basically, central bankers know that in that condition, salaries are still strong. Salaries are actually getting, how can I call this, uptrend pressures. Because if the employment rate is below 4%, it means like everyone got a job. It's easy to rotate your job. It's easy to go to one place to another if you receive better offer or better pay slips or high wages and so on. And therefore, inflation won't disappear in these conditions. The theory done by the Deloitte's report, it was the one I think I mentioned at the beginning of the video. The theory of this report made by Iran Kalish on Deloitte report on the weekly market review they do it. It was that in this situation, in these conditions, we also can consider that the house expenditure in US is still high, the consumption is still high, the numbers are still going well, the sales numbers, retail sales are still working well, because the savings from the COVID, from pandemic are still on, and they still got an excess of savings to spending, even if the interest rates are higher and the conditions in the economy are getting more hard. But the Federal Reserve of Chicago were making also a study on this topic, and they mentioned by June 2021, the savings, the excess of savings on the house in US and households in US, it was 2.1 trillion. They estimate by June of this year that number was dropping to 190 billions, and they considered by the end of this quarter, by the end of the Q4 2023, probably the excess of savings will be gone. Still, if the labor market is strong, the salaries are gonna keep pushing up, and the expenditure by houses is gonna probably strong enough to keep the retail sales active, which is just the macro numbers that we usually follow to understand if the US economy is strong or not. So I'm giving to you the charts, I'm giving to you the goals of the price, but I'm also explaining to you the background of these movements and how to understand if the US economy is gonna go up or down. Let's take a look also to NASDAQ, because it's the strongest equity index we can find in US, the strongest probably in the world, the technological sector of the US economy. And as you can see, the figure is very similar to the one we see in the SPY 500. You can even drop here also shoulder head shoulder figure or pattern, more or less. We also can see that the uptrend, it's getting broken by the movement of the price. Let's just project the line about the price, and you see it's losing those levels. It's fighting with the moving average of 50 periods. If it's lost, I guess the projection probably is move the price to the area around 14,000 points, 3,950 points, more or less. That's probably the goal. Remember, this is not advice of any kind. I'm just sharing with you my view on the market, but I'm not here to tell to no one what to do with the money. And my advice, if it's any, is just to consult or contact an expert advisor, financial advisor, and ask them what to do based on their knowledge, what to do with your money. Okay, I'm not here to tell you what to do with your money. I'm just sharing with you for free my ideas. So we have checked equity, Standard & Poor's, NASDAQ. We also have seen Euro dollar, index dollar. We're gonna take a look on we also have seen fixed income. We're gonna take a look now in equity on Europe. This is the DAX, and as you can see, it's also in my eyes at least is clearly weak. You can see how the movement is getting in a kind of lateral movement for the last month, more than a month. You see, we got here numbers. Also, I have explained this. This was the first movement, uptrend movement by the end of the last year and the beginning of this year. There was the second one, and I want to just show you how strong it was the first one, this movement, how this one was getting weaker and slower, and this one obviously is the longest one and slower one. It's the movement, the up movement is slower, it's weaker than the previous one, but also the result is a lateral movement that obviously doesn't show that the investors are so convinced to invest in German market with these movements on the charts, right? So I believe that we are trying once again to break out the 16,000 points. Still, they cannot do it. You see, it's giving a clearly resistant area on this zone, and obviously, I believe the price gonna start twisting back, and back again. And at some point, either this area or either this area gonna get broken, and the price gonna move to the next levels. The thing is, if the price is moving uptrend, always following uptrend, and it's moving here, it's gonna find resistance in 16,300 points, clearly by the chart, because there's three tops already in that area. But if the price is losing the 15,500, 50,450 points, what we got is a massive drop on the prices. You see, because it's gonna be the whole correction of the full movement. I mean, if I take and we use a FIBO retracement, we will see that actually, you see, 50% of the movement, just 50% on correction of the main movement done from the beginning of the year will take the price to 14,400 points in DAX. If I check also the Spanish market and the Spanish index, I will find out that it's in a very similar situation. 1, 2, 3, 4, 5 tops, 5 times going over 9,500 points, 9,600 points, and still turning back over and over again. So again, this is a pulse, this is a kind of competition, a match between buyers and sellers to conquer this market. But if you check the macros on Europe, the numbers are not good. The economy is weak. The growth rate is super pure. It's like 0.50% annually, 0.50% annually. German economy is growing. The estimation of the growth of the German economy for this year is minus 0.20. So obviously with those numbers, there is low incentive to invest in German or Spanish or European stocks. Now, checking the gold, and oil. We need to check gold and oil. Gold, it's getting cheaper. Now it's rising. But yesterday was just starting from a 1,914, 15. And it's a natural movement considering the movement of the dollar. If the dollar is getting stronger, the gold is getting cold. The price of the gold is dropping and so on. And if we take a look in long term, mid and long term, we will see that actually what is going on in in gold, it seems to be a natural movement that is not even over. Yeah, because you can see that it's actually rectifying all the movements done. Probably to move in the direction of $1,825, $1,800 per ounce. So it means like we still have too much to see dropping. Even if I go to different time frames, we will see that it's actually a bear trend. Let me just with the proper lines here. Here we go. I'm gonna duplicate this movement just to be sure that we got a clear view on the price. That's it. All right. So again, I think the evolution of gold, what we can expect the coming days is just again a price that is getting weaker and weaker. Considering that U.S. economy is strong, dollar is getting fit by high interest rates on the economy, very good and attractive yields on the bonds. Money is moving to the dollar. If money is moving to the dollar, dollar is a good deposit, dollar is a good asset, and therefore means like there is no reasons to cover your exposure to dollars with gold because the trend is a strong dollar. So I don't need gold anymore in these conditions. Let's check also what's the situation of Brent because it was a strong movement also in gold during this week. Here we go. You see, it's almost at $94. Almost. It's amazing. Okay, it's a really strong movement. The one done by oil, British oil, and I guess we can expect after this. First of all, take a look to the dilatation of the price. Actually, let's move the line to project how long it was that dilatation. We saw that. Back in summer 2022, the oil was rising. It was also taking prices over those lines. It means like still today, we could expect that the oil could eventually drop and move to the levels of $90 per lot, per barrel, and from there start to consolidate the price again. But it seems to be really, really nice and strong. This is an energy war. It's a war on energy done by US, Russia, and now apparently Saudi Arabia is playing in the ban or in the team of Russia, just reducing the exportations, reducing the production. Russia is reducing the exportations. Saudi Arabia is reducing the production until the end of the year, and all of these movements are basically going against the US interest because it means like if the oil is rising, inflation could eventually rise back again. And the Federal Reserve gonna need to keep increasing interest rates, and it's a race that you cannot win in the long term because after 6% interest rate, let's say 6% as a reference. After 6% on the referral interest rates in US, we have seen historically few strong crashes. So I believe Federal Reserve want to be at any cost keep away from 6% of interest rates, and they are ready to close. So they need to get the inflation under control. If the oil is still rising, that could push up the inflation and cause troubles to them. And last, but not the last important one, Bitcoin. We got here the movement done by Bitcoin is in $26,343 per Bitcoin. And still, I believe it's strong support levels. We also got the 200 periods moving average in that area. The bad news is the price is quoting below the moving average for the first time in a while. So it means that we probably need to keep an eye on this just to. But if still, remember my idea with Bitcoin, my theory, my point, my position is Bitcoin is a buy and hold asset. It's a safe haven. It's an asset to store your value with a very low cost compared with any other option. Therefore, whatever happens with the price, I'm gonna still get a bullish feeling on Bitcoin, especially because it's a medium long-term asset to keep in my portfolio, and I believe it can generate very, very good results in the future because it's the world currency, period. That's it. It's the world currency. Even when the governments don't know yet, even when the regulators are completely lost, it's a fact. It's already universally accepted by the rest of the countries. Many countries are using Bitcoin now. Many private users, individuals, are using Bitcoin in transactions. And it means like in the future, especially with the fixed and tax control set in by governments in China, in Europe, in US, where the money it is actually, that is where the money it is, where the investors got more savings. In that case, it's a matter of instinct to move your savings to an asset like this. Okay, that's all. I think that was a good review. That was a full 360 degrees view on the market. And I hope to see you in the next videos next week. Okay, enjoy and good luck with your market. Bye-bye.